Hi, everybody. This is Dan Sheridan. It's Tuesday, April 18th. We're still in the morning here, and I'm going to talk about these 0 days to expiration trades you would put on today. So today's Tuesday, April 18th, that expire today. And they're the rage in the options communities these days, 0 day or very short-term trades, 2 or 3 days out. And if you said to me, Dan, why do you think they're the rage? 2 things I'd say. Hey, it's great that people are getting interested in options, but it's more the gambling, right? When they're getting in these 0 day trades. But I thought, well, that's great. If they come in options, they learn it. I'm glad people are coming in, but it's the obligation of people who traded options a while to say, okay, the 0 day is fine. Let's look at them. But the focus has to be on the risk management, right? That, to me, I'm looking at, okay, for the most part, range bound trades, how would I make money on these trades? And so I'll start a series of 0 days to expiration type teaching on YouTube and go over some of these. And today, just a couple things I want to just point out on just this example. So here I'm just looking at an example. If I'm looking at 0 day trades, I like to have kind of a foundation for a trade that I'm going to put on a short strangle. Dan, what's the heck are you talking about? All right, if we're at 41.45 right now, I'd want to get a little bit of room, selling an out of the money call. In this case, I'm selling strike 2 points up, 20 points up, 41.65 call. And on the put side, about 20 points down, 41.25. Now, so that's called a short strangle. Selling an out of the money call. Here's where SPX is trading. And then selling an out of the money put. So I'm going to whip a couple things at you that may be new, but I want to throw it at you. Other thing I want you to focus on is sometimes you'll look at, okay, for 0 day for today, options expiring today at the end of the day, the expected move or one standard deviation is about 15 points. What does that mean in English, Spanish, and Norwegian? It means that if this is the price right now, and we're looking at plus or minus 15, you could say maybe by the end of the day, we could be 15 points higher, maybe 41.60, 15 points lower. It might be 68% probability roughly. And you're not getting a lot of room right now necessarily. You say, why? Well, we're at the lowest VIX levels. I'm throwing another thing at you. First, if you're newer, you're saying, well, Dan, first you threw a short strangle at me. You're selling an out of the money call and put to get a little more room, get the probabilities in your favor. We're selling this to get the time decay of these trades. Then you threw out the expected move is 15 points. So you want to, okay, I want to maybe sell my options near the expected move, get some room. And then this other concept, VIX, is 17. That's the low end over the last year. Volatilities are very, very low right now, lowest they've been in a year, basically. What does that mean? It means you're not going to get as far out as you normally would, right? If the VIX was higher, our expected move, instead of being 15 points, might be 30. That's the way it is right now, right? So I like strategies that there's 4 strategies that their foundation is an out of the money put and call. Number 1, an iron condor. Number 2, and we'll talk about these in future webinars, double long diagonal, double diagonal, and today a double calendar, right? These 3 are mixed month spreads. 2 different expirations. This is iron condors, 1 expiration. So these are generally one of these 4 I will use on a given week. And a double calendar or any mixed month spread, just to give you the dynamics of it, I'm selling the near term, a mixed month, and I'm buying a further out duration. So mixed month, different durations, usually buying the further out one, and different strikes. Mixed month would be, that's mixed month, right? But this particular strategy, double calendar, if I'm selling my call 20 points up, April 18th, April 19th, I'm buying same strike, right? So calendar, same strike. And on my puts, I'm selling at 41.25, I'm buying it. Now, you look at the graph, and the blue graph would be more an idea of what it would look like at the end of the day, but it's not exact, because with a mixed month spread, versus a same month or same day spread, a spread with has the same expiration. When it's a mixed month spread with different expirations, that blue line can change a bit, but that's an idea of what it looks like. So at the end of the day, so you can say, well, my expiration, here's another concept thrown at you, expiration break even, where the expiration graph, which is the end of the day today, crosses zero. So you can see with an expected move of 15 points, I can handle an expected move of down about twice of that, down 30 points and up 30 points. Because if you look at here, my expiration break even is about 41.15 and 41.75. So this is a double calendar. So the Greeks, when you look at the mixed month spread, are useless, because this says I have a negative theta. But you look at the blue graph, that's not true, right? It's not true. Things can happen. Volatility, things can happen with volatility that if we sit here, you might not make money necessarily, but it's more the blue graph, because is more real. The April 18s are going to decay a lot more than the April 19s. Why? Because the April 18s, their life expectancy ends at the end of the day. April 19s, they still have a day to go. So that's hard getting used to. Say, well, ignore the theta on a mixed month spread, especially where your long is one day out past your short. But anyways, I threw a lot at you today. I'll come back another day and throw them, but for review, and we'll come over next time. We talked about a double calendar today, a mixed month spread where the strikes on the call side are the same, strikes on the put side are the same. Talked about an expected return. That's a concept that comes into play with 0-day options and maybe how we structure them. We talked about VIX levels and kind of their role in the expected move. Next time I'll get in a little bit more on the simple risk management. What do you do with risk management with 0-day trades versus if it was a 15-day or 20-day trade. So anyways, we'll come back. This is Dan Sheridan from Sheridan Mentoring, and have a great day. Thanks.